Moving average envelopes are percentage-based envelopes set above and below a moving average. The moving average, which forms the base for this indicator, can be a simple or exponential moving average. Each envelope is then set the same percentage above or below the moving average. This creates parallel bands that follow price action. With a moving average as the base, moving average envelopes can be used as a trend-following indicator. Beyond simply trend following, though, the envelopes can also be used to identify overbought and oversold levels when the trend is relatively flat. Calculating moving average envelopes is straightforward. First, choose a simple moving average or exponential moving average. Simple moving averages weight each data point, or price, equally. Exponential moving averages put more weight on recent prices and have less lag. Second, select the number of time periods for the moving average. Third, set the percentage for the envelopes. A 20-day moving average with a 2.5% envelope would show the following two lines. The chart on the screen shows IBM with 20-day SMA envelopes set at 2.5%. See the blue lines. Note that the 20-day SMA, see the red line, was added to this chart for reference. Notice how the envelopes move parallel with the 20-day SMA. They remain a constant 2.5% above and below the moving average. The parameters for the moving average envelopes depend on your trading, investing objectives and the characteristics of the security involved. Traders will likely use shorter, faster, moving averages and relatively tight envelopes. Investors will likely prefer longer, slower, moving averages with wider envelopes. A security's volatility will also influence the parameters. Bollinger Bands and Keltner channels have built-in mechanisms that automatically adjust to a security's volatility. Bollinger Bands use the standard deviation to set bandwidth. Keltner channels use the average true range, ATR, to set channel width. These automatically adjust for volatility. Chartists must independently account for volatility when setting the moving average envelopes. Securities with high volatility will require wider bands to encompass most price action. Securities with low volatility can use narrower bands. In choosing the right parameters, it often helps to overlay a few different moving average envelopes and compare. The chart on the screen shows the S&P 500 ETF with 3 moving average envelopes based on the 20-day SMA. The 2.5% envelopes, red, were touched several times. The 5% envelopes, green, were only touched during the July surge. The 10% envelopes, pink, were never touched, which means this band is too wide. A medium-term trader might use the 5% envelopes, while a short-term trader could use the 2.5% envelopes. Stock indices and ETFs require tighter envelopes because they are typically less volatile than individual stocks. The Alcoa chart has the same moving average envelopes as the SPY chart. However, notice that Alcoa breached the 10% envelopes numerous times because it is more volatile. Moving average envelopes can be used to identify strong moves that signal the start of an extended trend. The trick, as always, is picking the correct parameters, which takes practice. Trial and error. The chart on the screen shows Dow Chemical, Dow, with the moving average envelopes 20, 10. Closing prices are used because moving averages are calculated with closing prices. Some chartists prefer bars or candlesticks to utilize the intraday day high and low. Notice how Dow surged above the upper envelope in mid-July and continued moving above this envelope until early August. This shows extraordinary strength. Also, note that the moving average envelopes turned up and followed the advance. After a move from 14 to 23, the stock was clearly overbought. However, this move established a strong precedent that marked the beginning of an extended trend. With Dow becoming overbought soon after establishing its uptrend, it was time to wait for a playable pullback. Traders can look for pullbacks with basic chart analysis or with indicators. Pullbacks often come in the form of falling flags or wedges. Dow formed a picture-perfect falling flag in August and broke resistance in September. Another flag formed in late October with a breakout in November. After the November surge, the stock pulled back with a 5-week flag into December. The Commodity Channel Index, CCI, is shown in the indicator window. Moves below -100 show oversold readings. When the bigger trend is up, oversold readings can be used to identify pullbacks to improve the risk-reward profile for a trade. Momentum turns bullish again when CCI moves back into positive territory, green dotted lines. The inverse logic can be applied for a downtrend. A strong move below the lower envelope signals extraordinary weakness that can foreshadow an extended downtrend. The chart below shows International Game Tech, IGT, breaking below the 10% envelope to establish a downtrend in late October 2009. Because the stock was quite oversold after this sharp decline, it would have been prudent to wait for a bounce. We can then use basic price analysis or another momentum indicator to identify bounces. The indicator window shows the stochastic oscillator being used to identify overbought bounces. A move above 80 is considered overbought. Once above 80, chartists can then look for a chart signal or a move back below 80 to signal a downturn, red dotted lines. The first signal was confirmed with a support break. The second signal resulted in a whipsaw loss because the stock moved above 20 a few weeks later. The third signal was confirmed with a trend line break that resulted in a rather sharp decline.